things. I think first of all, on an overall macro perspective, if you look across at last uh, 12 to 18 months, okay, after the COVID thing settled on the first 6 months, I think there has been significant deleverage of corporate balance sheets which has happened. There has been significant liquidity infusion. Credit flow has happened to the right segment for the last 2 years. So RBI government put together has ensured that any kind of stress builds up before that, they will provide those emergency credit lines. Uh, Thanks to all COVID concerns, I think corporates significantly raised liquidity. And somewhere down the line, we have also got, because our growth parameters and macro perspective was looking very, very good from both demand perspective as well as the overall macro for India. I think we have been able to raise a lot of capital. So strong capital, deleveraging of balance sheet, liquidity getting raised, plus all kind of intervention from government and RBI to ensure that somewhere down the line there is no accident or everything has been taken care of. I think somewhere down the line led to significant improvement in the credit cycle. If you see, there has been this report which have now released that over the last 12 months or so, the upgrades have significantly outperformed the downgrades. We have actually seen the upgrade downgrade ratio in favor of upgrades, and it is by a huge margin. So I think better macro has helped for a significant improvement in credit cycle, and which has led to somewhere down the line compression of credit spreads. I think second reason is that somewhere that outliers or significant high performing high returns on credit funds. There are a couple of credit funds, or at least what we understand, there is some write backs also. But as a category, credit funds have done significantly well because of the improved macro environment. I would keep aside those outliers because there they have some write backs of previous downgrade, restructured or default assets, which has led to some massive outperformance for certain credit funds. But I would say as a category, I completely agree. They have outbeaten most of the other fund categories for the last 12 months. And the reasons attributed to pure improved macro environment, improved credit environment, compression of credit spreads, and which has led to the outperformance. See, I think the investor needs to understand while he's investing in a credit fund that somewhere down the line, the portfolio contains 65% and below AA and double A and below rated assets. So 65% or more has to be in a double A and below rated assets. And that is a more important distinguishing factor. So investors who are investing in credit risk funds always should look at and understand that these are there can be credit volatilities and there can be some kind of credit risk into the portfolio. Coming back to our thoughts on macro, so how do we link credit cycle? I think it's a very, very top-down approach. We link it, and over last so many years, our thought process has been that it is very, very directly linked to the growth cycle of the economy. When we look at basic macros, okay, I think some, and as I explained you, the reason for why corporate balance sheets are looking far much better than what they were before. Secondly, on the credit cycle, because there has been improved demand, there is good credit flow, there is ample liquidity with the banking system. All this is significantly augured well for the credit cycle as well as helps corporate balance sheets. So in the near term, because of the macroeconomic indicators, yes, our view is the credit cycle looks good and we don't anticipate any significant deterioration in credit, or we actually don't believe so that there will be huge credit defaults in the near term. But foreign investor who is investing in credit risk fund should always understand and know that credit funds are subject to credit risks, and there can be, if the cycle deteriorates or we see a global shock. Okay, so investors who are investing credit funds should always know these kind of that they are entering into a credit risk which is subject to downgrades and at times defaults. If you look across at YTMs of credit funds, which are, I would say, the larger fund houses, they are all hovering around 6.5 to 7.5 band. And when you look across and compare them with AAA funds of similar duration, which are short-term and corporate bond categories, their YTMs are generally, I'm talking about last month's published yields. They are more broadly in the range of 5.5 to 6%. So there is a good, decent 150, 200 basis kind of a 150 basis kind of a spread over a AAA funds on yields, and which probably will help to deliver good returns in the next 12 to 18 months or even 24 months for investors, because As I explained, our view is the credit cycle continues to remain strong, and we believe that credit spreads can see some bit of further compression from here on. I personally believe that AA spreads have significantly compressed over the last 12, 18 months. They can see some bit of compression more. Single A assets in the next 12, 18 months will see more compression as compared to AAA. So improve credit cycle and the good spreads which are already available will help investors to get good returns from these category in the near term. One is investors who have an appetite so to invest or the risk appetite, they understand what is credit funds. First of all, they need to understand that 65% of the assets are invested in AA rated assets and AA rated and below assets. Secondly, the more important element what investors need to understand is that somewhere down the line, the when you're investing in credit fund, okay, you are targeting a kind of a corporate FD kind of a return. So investors who understand credit risks is something what they should target credit risk funds. So I think the thought process for category of investors is more prone towards corporate FD kind of investors. See, I think we follow the principle of diversification. So what we believe is that credit risk funds which are well diversified will be able to withstand any kind of volatility. And at any point of time, if you see a bad credit cycle or a default also, the impact of that on the return is significantly less. So our mantra has always been in the credit risk fund to run a very, very diversified portfolio to keep ample liquidity and keep staggered maturities so that if a 2013, 14 or 2018, 19 kind of an episode repeats, we don't see any kind of stress on the returns as well as we don't see any kind of stress for the investors. So I think well diversified portfolio, no concentrated bets and lower duration credit funds makes a lot of sense to me at this point of time.